Hello, and welcome to the Sunday Report, where we give you a clear-eyed view of the week's biggest economic and political shifts. With context for every major region, this is your one-stop shop for a grounded global perspective. This week, we've seen tensions over tariffs escalate in North America, fresh uncertainty in Venezuela's oil sector, a political earthquake in Japan, and the ongoing shadow of conflict and diplomacy in Europe and the Middle East. Let's look at what actually happened, why it matters, and how these stories might affect global markets. There are timestamps below in the description so you can skip to the regions or sectors that matter most to you. Let's start in the Americas. On February 11th, the U.S. House delivered a narrow but notable challenge to President Trump's Canada tariffs, with a handful of Republicans crossing the aisle. The move is mostly symbolic, as Trump has promised a veto, but it signals growing discomfort in Congress with sweeping executive trade actions. Manufacturers like GM are bracing for billions in additional costs as the threat of even steeper tariffs if Canada finalizes a trade deal with China, keeping supply chains on edge. In Venezuela, the oil industry, under new U.S.-led oversight after President Maduro's removal, has begun granting more access to foreign companies like Chevron and Repsol. Production remains stuck below 1 million barrels a day, most of it still bound for China, while the U.S. exerts tight control over revenue and export channels. In the short term, North America, the House vote won't change tariffs overnight, but does highlight rising political risk for trade-dependent sectors. Companies with cross-border operations will likely face higher costs, more supply chain headaches, and the real possibility of sudden policy swings. In Venezuela, oil exports stay tightly controlled and limited, keeping a lid on near-term recovery and contributing to a global oil market that's already wrestling with oversupply. In the long term, if trade conflicts between the U.S. and Canada escalate, it could dampen North American growth, upend established supply chains, and push companies to diversify production. Venezuela's oil sector faces a slow road back, with billions investment and years of work just to regain lost ground. The interplay between geopolitics, energy policy, and trade will continue driving uncertainty in global markets.
NATO's gradual shift of command duties to European forces isn't just a bureaucratic move. It's a symbol of Europe's intent to step up in its own defense. Armenia's pivot toward the U.S. in nuclear energy marks a break from Russia's traditional sphere of influence and could have long-term implications for alignment. Meanwhile, Ukraine-Russia talks remain deadlocked, and the financial and human cost of the conflict continues to weigh on Europe. For the shorter-term outlook, increased European responsibility in defense could mean higher budgets for military spending, potentially squeezing out domestic investments and projects. The Armenian-U.S. deal may provoke Russian pushback, raising geopolitical risk in the Caucasus. With no breakthrough in Ukraine, markets are likely to price in ongoing volatility, sticky inflation, and a cautious European Central Bank. The longer-term impact: if the current trajectory holds, expect a reshaping of Europe's security architect and perhaps a more fragmented economic landscape. Cross-border partnerships and alliances will continue to be tested, both internally and externally pressures, influencing everything from energy policy to investment flows and regional stability.
In Asia, Japan's landslide election result gives Prime Minister Sanae Takachi a rare supermajority and a powerful mandate to tackle major reforms and even constitutional changes. The unexpected scale of victory has brought short-term calm to the Japanese markets and boosted the yen, but it also raises expectations for bold moves on policy, economics, and possibly foreign affairs. In Thailand, voters approved a new constitutional reform path, signaling hunger for stability after decades of political churn. In the short term, Japan's newfound political stability is welcome news for markets with steadier bonds and a stronger yen. For exporters, though, a firmer currency could pinch profits. Thailand's reform process is only just starting, while the vote signals hope for change, actual progress will be slow and closely watched by investors and neighbors. In the long term, with this supermajority, Japan could push through the long debated reforms that shaped the country's economy and its role in the region for years. But the same political strength could embolden more assertive foreign policy, introducing new uncertainties in the Asia-Pacific region. In Thailand, the outcome of constitutional reform will set the tone for either a more stable democracy or a renewed cycle of unrest.
U.S. and Iran nuclear talks are ongoing but hampered by familiar sticking points. Iran's missile program and enrichment rights remain non-negotiable, even as sanctions bite harder. The recent EU terrorist designation for Iran's Revolutionary Guard has also raised the stakes. Meanwhile, the UAE and Russia are deepening energy cooperation, offering a reminder that global energy flows are adapting to sanctions and shifting alliances. For the shorter term, the risk of escalation in the Gulf remains high. Any disruption, whether diplomatic or military, could send oil prices sharply higher and add to global inflation. The expansion of UAE-Russia liquid natural gas deals might help Asia buyers in the near term, but overall, supply risk and sanctions will continue to weigh on regional and global energy markets. For the longer-term impact, success or failure in these nuclear talks will shape not just energy prices, but the broader security environment in the Middle East for years to come. As countries like the UAE and Russia diversify their trading partners, the landscape of global energy and the balance of power continues to evolve.
Moving into currency markets, the past week in currencies has been a study in shifting forces. The US dollar softened with the dollar index slipping to 96.88 as investors weighed steady job growth against cooling inflation and the likelihood of 2 Fed rate cuts later this year. But this isn't just about US data. Global flows are shifting too, as investors diversify away from the dollar in response to a more multipolar world. The euro has held above $1.18, buoyed by stable policy from the ECB and positive services data. There's still resilience here, even as the region faces slower growth and persistent inflation. The British pound has been steady around $1.36, reflecting relative economic stability and the UK's status as a safe haven amid global uncertainty. In the Asia-Pacific, the Japanese yen strengthened dramatically after the election, with the dollar-yen pair moving closer to 152. Political stability matters in currency markets, and the Takechi government has signaled it will support the yen if needed. The Australian and New Zealand dollars both gained on solid export demand and hawkish central bank stances. Commodity strength is still a powerful driver, and the Canadian dollar remains volatile, caught between trade headlines and oil price swings, while the Swiss franc has drawn safe haven inflows, appreciating to 76 cents against the dollar. What does all this mean for investors and businesses? Currency markets are more sensitive than ever to changes in policy, geopolitics, and even sudden shifts in global sentiment. The dollar's dominance is being quietly challenged, and regional currencies are finding new sources of strength and vulnerability. For anyone who has cross-border exposure, whether you're an exporter, importer, or investor, expect more volatility and more need to hedge.
Equity markets have shown divergent trends across regions. In the U.S., the S&P 500 ended near 6,800, essentially flat for the week as investors rotated out of high-flying tech stocks and into more defensive, value-oriented names. The Dow Jones performed slightly better, led by steady gains in healthcare and consumer stocks, while the Nasdaq slipped further on concerns about the sustainability of AI-related infrastructure spending. In Europe, the FTSE 100 and DAX both managed gains, supported by robust energy and industrial shares and the prospect of massive government spending in Germany. The CAC 40 in France lagged, with luxury stocks under pressure and growth concerns lingering. The Euro Stock Exchange reflected the region's mixed mood, ending the week slightly lower. Asia-Pacific markets saw broader weakness. Japan's Nikkei fell after the post-election rally and faded, and a stronger yen put pressure on exporters. Hong Kong's Hang Seng and China's Shanghai Composite both dropped as the property sector and stimulus worries persisted. Australia's ASX 200 was hit by commodity swings and expectations of further rate hikes. Globally, the message is one of sector rotation and resilience in the face of uncertainty. U.S. markets are adjusted to a new cycle where inflation is cooling, but growth is uneven and policy paths are less predictable. European markets are fragmented, with domestic headlines driving performance. In Asia, markets are closely watching political and policy signals, with long-term structural reforms holding more weight than short-term volatility. Volatility remains elevated but controlled, with the VIX at 20.6 above its long-term average, but well off the panic highs seen during past crises. Investors are cautious, but not running for the exits.
Energy and metal markets have been anything but quiet. Brent crude is trading between $67 and $68 a barrel, reflecting a tug of war between oversupply with U.S. inventories hitting multi-year highs and the ever-present threat of Middle East disruptions. WTI crude is a few dollars lower, maintaining its usual discount. If diplomacy with Iran collapses or supply routes are threatened, oil could move sharply higher. But for now, markets are more worried about too much supply than too little. The International Energy Agency continues to forecast a surplus for 2026, which could mean prices settle lower over time despite the short-term spikes. Gold has been a case study in volatility after hitting a record of $5,600 an ounce in late January, only to crash 12% in a single day following the Fed chair nomination. Prices have clawed back to around $5,000 an ounce for now. Central bank buying and ETF inflows remain strong, and gold's traditional role as a hedge is alive and well, especially as investors look for alternatives to dollar-denominated assets. Silver, meanwhile, has been even more dramatic, with huge swings tied to both industrial demand for solar panels and EVs and financial speculation. The metal is hovering near $78 to $79 an ounce, but remains prone to sudden moves as traders react to margin changes and supply news. Copper is the industrial bellwether to watch, prices shooting up above $11,700 per ton, fueled by a rush to secure supply ahead of potential U.S. tariffs and by relentless demand from AI data centers and electric vehicle manufacturers. Some analysts warn the market may be running hot, but the structural story, electrification and digital infrastructure, remains hard to ignore. For many manufacturers and builders worldwide, copper has become a strategic input, not just another commodity. In summary, commodity markets are being shaped by both traditional forces with supply and demand fundamentals in geopolitics and new trends with energy transitions, digital infrastructure, and shifting trade flows. Volatility is high, and opportunities and risk are everywhere.
Last, but definitely not least, we have the upcoming economic calendar news. So earlier today, Christine Lagarde spoke at the Munich Security Conference, rejecting proposals to tax capital outflows from Europe, arguing instead for creative investment incentives. The ECB held rates steady at 2% on February 5th, with inflation at 1.7% in January, below their 2% target. Next ECB meeting is March 19th, and markets expect rates to remain unchanged through 2026, with experts watching the strengthening euro and inflation trends closely. Later today, we're going to have the Japan GDP reading. What can we expect from that? Market consensus looks for 0.2 to 0.4% quarterly growth, signaling a gradual rebound over a volatile year. A softer figure could weigh on the yen and stoke worries about Japan's recovery, while a stronger number might spark fresh yen buying and affect global carry trade flows. The data will also be an early test of investors' confidence in Japan's new government.
Monday, February 17th, Eurozone CPI numbers are out. Markets anticipate confirmation at 2.1 to 2.3%, in line with the earlier readings. If the data matches expectations, it reinforces the ECB's patient stance. Any upside surprise might delay easing expectations and provide a short-term boost to both the euro and Eurozone equities, particularly the DAX. The UK has employment numbers being released. The UK labour market remains a focal point for the Bank of England. Analysts expect the claimant count to rise by 20 to 30,000, with unemployment remaining steady near 4.2%. Robust data could underpin the pound and support the FTSE 100, while a weak print may amplify calls for earlier rate cuts. We have Canada's consumer price being released, with Canadian headline inflation projected around 2% to 2.2%. A cooler than expected number could ease pressure on the Bank of Canada to hike further, potentially softening the CAD but aiding Canadian stocks. A hot reading would push rate cut bets out and lift the Canadian dollar.
So moving forward to Tuesday, February 18th, we have two major news events. We have the New Zealand interest rate decision and statement. First off, what can we expect from this? Well, the Reserve Bank of New Zealand is expected to hold rates steady and reiterate a patient stance given export resilience. Markets will be looking for any hints of a shift, whether dovish signals could weigh on the Kiwi, while a more hawkish tone may drive it higher and support the New Zealand Stock Exchange. Second thing we'll see is the UK Consumer Price Index. UK CPI is forecasted at 2 to 2.1%, with core inflation near target. A balanced result will likely affirm the Bank of England's cautious approach and keep the pound stable. Any significant deviation could shift yield expectations and drive longer moves in both Forex and UK equities.
Thursday, February 20th, we have Eurozone flash PMIs. The composite readings are anticipated in the 50.8 to 51.2 range, signaling modest expansion. Stronger PMIs would highlight ongoing recovery and support the euro and the Euro Stock 50. Weak numbers could amplify ECB caution and apply downside pressure to equities and the single currency. We have US Core PCE Price Index and GDP Q4 Advance. The core PCE, the Fed's preferred inflation gauge, is expected at 2.8% year-on-year, with GDP growth around 2.3 annualized. Softer numbers may reinforce rate cut expectations, softening the dollar and boosting risk assets. Above consensus results could steady the dollar and support U.S. equities. We also have U.S. S&P Global Flash PMIs. The composite PMIs should print near 52, with manufacturing holding above 50. Stronger than expected results could buoy the dollar and U.S. stocks, while misses may drive further talks of Fed easing and help commodity currencies.
So this wraps up our pilot episode of the Sunday Report. Let us know in the comments down below what you liked about it and what you want to see more of. Also, like the video and subscribe so you never miss a future Sunday Report.
And thanks for watching.